Now that it's tax time for the financial year, I'm going to discuss with you capital gains tax, the most important type of tax for stock market investors. How's it going, guys? Ryan here with another wealth management video today, and today we're talking about capital gains tax, also known as CGT. But before we get into that, guys, please remember to like this video if you do enjoy it and leave a comment down below about your thoughts on capital gains tax. And if you did enjoy the video as well, please remember to subscribe for more content like this. We talk about stocks, investing, wealth management, all sorts of cool stuff like that. So without further ado, let's get straight into the video. And as I mentioned previously, we're talking about capital gains tax, or CGT. This is by far the most important type of tax for any investor on the stock market to understand, and any investor probably in general. Now, what is capital gains tax? Well, effectively, capital gains tax occurs when you buy an asset and then sell that asset. So, for instance, if you make a profit on an asset that you have bought, then sold for a higher price, that is known as a capital gain. Whereas if you made a loss, that is known as a capital loss. Now, for individuals and businesses, this varies. So if you're operating under a business entity, CGT is only 30%. Whereas if you're an individual, your tax will be the same as your income tax brackets, and effectively it's treated as an addition to your income. This is why it is smart for people to set up business entities to deal with those sorts of things regarding assets where they're making money. Because what occurs is that you can reduce your tax rate if you're in a higher income tax bracket than the 30% that is associated with a business entity. In doing so, you'll effectively be able to reduce your tax rate overall. So if we're looking at the stock market, stocks are effectively assets. You're buying into a company, so you're buying an asset. When you buy a stock and then sell it, you will incur capital gains tax. If you buy a stock and you hold onto it, that is not a capital gain. If it goes up in value or down in value, it's not a capital loss either. Effectively, it's only when the second part of the transaction occurs, so when you sell that asset. In saying that, if you do receive something such as dividends, that is known as a capital gain because it's money you've generated through that asset itself. It's similar to if you bought a house for $500,000, then sold it for $700,000, for instance, you would effectively pay the capital gains tax on that 200 grand profit. And if you're looking at a renting situation, any income from that rent, which is a profit, will have capital gains tax associated with it. So effectively, you can put this all together and apply it to any situation involving assets where you're making either a capital gain or a capital loss on that asset. Now, one interesting point to note, particularly when we're talking about stocks, if you hold a stock for greater than 12 months, you will only incur 50% of the capital gains tax when you sell that stock. Now, that is absolutely fantastic for long-term investors because you're effectively halving the amount of money that you need to pay to the tax department. Similarly, if you own real estate, for instance, then if you live in that home for 12 months or more, you will only have to pay 50% capital gains tax. This is a bit different if you buy the property and then you effectively have it rented out immediately. You actually need to live in that property. So when it comes to stocks, it's a bit easier because it's automatically 12 months from the time that you buy the stock. One interesting point to note is when you are doing your tax when it comes to stocks, you can choose which packet you want to sell. So let's say you bought $100 of a stock on the 1st of October, and then you bought another $100 of a stock on the 1st of January the following year. If you get to tax time and some point you've sold half of those shares, you can choose effectively which ones you have sold. So for instance, it might not have exceeded that 12-month point, but for the final one that you bought, you might want to get rid of that first because you know the original one you bought is going to last longer and it's going to incur that 50% discount at a quicker rate. These are some of the things you need to think about when it comes to capital gains tax, because if you understand how it works, then effectively what you can do is use it to your advantage. Let me give you another example. You can offset capital losses against capital gains. So for instance, if you incur a loss of $100,000, all your profits you make up until you make up that $100,000 again is tax free. Yes, it is tax free. So if I lost $50,000 on a stock and I made $50,000 on another stock, that is tax free. And even better than what you can effectively do is roll it over year on year up until the point that you make up that amount. So effectively there's no expiry date in that sense. And this is really good for investors because it means you're only paying tax on profits where you genuinely make money. So if you've lost money previously and your stocks on other ones which have gone up go up in value and you've made a profit, then you don't have to pay tax if it is below that amount. The second you get 1 cent above that amount, you owe tax on whatever amount of money that is. But this is a great way in order to leverage your losses and use your losses as a way to get money back from the tax department when it comes to tax time. So guys, I hope that was a pretty clear and simple rundown of what capital gains tax is, how capital gains losses work, and I hope you enjoyed the video as well, guys. And if you did, please remember to give me a thumbs up. It really helps out with the algorithm. Subscribe if you enjoyed this sort of content, and leave your thoughts down below on capital gains tax and some other strategies which you use in order to reduce the amount of money you need to pay. And with that, guys, I hope you have an awesome day. See you next time. Cheers.